Whole life insurance is marketed as a permanent asset, but for 99% of investors, it is a mathematically inferior choice compared to unbundling protection from investment. In the first 2 years of a typical policy, nearly 100% of your premiums go directly to agent commissions and administrative overhead, rather than building equity. A $500 monthly premium for whole life insurance often buys less actual death protection than a $50 monthly premium for a 20-year term policy. If you take the $450 saved by choosing term insurance and place it in a low-cost index fund, the math begins to diverge aggressively. Over 30 years, a 6% return in a brokerage account turns those monthly savings into over $450,000, far exceeding the projected cash value of insurance. The greatest mathematical deception is the either-or rule. When you die, the insurance company keeps your cash value and only pays out the face value of the policy. Policy loans are framed as a benefit, but you are effectively paying interest to the insurance company to access your own accumulated savings, reducing your net death benefit.
If you need to cancel the policy in the first decade, surrender charges can wipe out a significant portion of your accumulated cash, leaving you with less than you contributed. Insurance dividends are technically a partial return of overpaid premiums, not a profit share. They are not guaranteed and are often lower than the inflation rate of 2026. While marketing materials highlight gross returns, the net internal rate of return for most whole life policies rarely exceeds 2 or 3% over the long term. Fixed death benefits lose purchasing power every year. A $500,000 policy purchased today will buy significantly less in 30 years due to cumulative inflation. The opportunity cost of high whole life premiums over a working career can easily reach over $1 million in lost wealth compared to disciplined independent investing. Tax-free growth is a selling point, but capital gains in a brokerage account are only taxed at 15 or 20%, and step-up in basis can eliminate that at death.
The implicit expense ratios in whole life products are often 5 to 10 times higher than those of a standard total stock market exchange traded fund. Insurance agents earn commissions that can equal 50 to 100% of your first year premium, creating a massive conflict of interest in their recommendations. Whole life premiums are mandatory. If you experience a financial hardship and stop paying, the policy may lapse and you could lose all coverage and accumulated cash. The guaranteed cash value growth is often so low that it fails to keep pace with the cost of living, effectively locking your capital into a depreciating asset. By buying whole life, you trade the historical 10% average return of the stock market for a capped return that prioritizes the insurance company's profitability over yours. Optional riders for disability or long-term care add even more layers of fees, further diluting the actual investment portion of your premium and reducing net returns. Statistics show that over 80% of whole life policies are surrendered before death, meaning most people pay high fees for a benefit they never actually receive.
Being a policyholder in a mutual company sounds like ownership, but you have no control over corporate expenses or the aggressive executive compensation packages funded by your premiums. The cost of insurance inside a whole life policy increases as you age. This hidden expense eats more of your cash value every year you keep the policy. The 100-page illustrations are designed to confuse. They mix guaranteed and non-guaranteed values to make the future look far brighter than the mathematical reality suggests. Maximizing your 401k, Roth individual retirement account, and health savings account provides superior tax benefits and higher expected returns without the insurance middleman. The purpose of insurance is to cover a risk you cannot afford. By investing independently, you eventually become self-insured, making any permanent life insurance policy redundant. Infinite banking proponents claim you can be your own banker. In reality, you are just borrowing at 5% to earn 3% on your own money. Money in a brokerage account is liquid and accessible. Money in a whole life policy is locked behind a wall of surrender charges and loan interest requirements. Beyond the insurance cost, you pay premium taxes, policy fees, and asset management charges that are rarely disclosed as a single, transparent expense ratio. It often takes 15 to 20 years for the surrender value of a whole life policy to simply equal the total amount of premiums you have paid in. The insurance company invests your premiums in conservative bonds. By doing this yourself, you eliminate their profit margin and keep the full yield for your own retirement. Agents cite estate taxes to justify whole life, but in 2026, the federal exemption is so high that this only applies to the ultra-wealthy. A smarter strategy is laddering term policies. You buy more coverage when your mortgage and children are young and let it expire as your assets grow. Unbundling gives you control. You can change your investment strategy or insurance coverage independently as your life evolves, without paying massive restructuring fees to an insurer. Whole life is capital inefficient. It ties up large sums of money for decades to solve a temporary need for protection that could be addressed for pennies on the dollar.
The forced savings argument assumes you lack discipline, but paying a commission to a corporation is a very expensive way to motivate yourself to save money. Unlike a mutual fund or a stock, you cannot see the real-time value of the underlying assets in your insurance policy or the exact daily cost of your coverage. If you take a policy loan and do not pay it back, the compound interest on that loan will eventually eat your entire cash value and collapse the policy. Look at any 40-year period in market history. Diversified equities have outperformed the cash value growth of whole life insurance products by orders of magnitude. Agents often receive massive year-end bonuses for hitting whole life sales targets, which further incentivizes them to push these products over lower commission term options. The math is simple. Subtract the cost of term insurance from your whole life premium. If that difference earns market returns, you win. If the insurer keeps it, they win. By age 65, the average whole life buyer has sacrificed between $500,000 and $2 million in potential wealth due to high fees and low yields.
Buy term and invest the rest is not just a catchphrase. It is a mathematically verifiable strategy to maximize your family's protection and your personal net worth simultaneously. Calculate your current internal rate of return by dividing your cash value by the total premiums paid. If the number is negative or near zero, you are losing money. Whole life insurance relies on your fear of the market and your misunderstanding of compound interest to generate profits for shareholders and agents at your direct expense. True financial security comes from owning your assets directly, not from participating in a complex, high-fee insurance contract that benefits the issuer more than the owner.